Just talk to me, bro. I want to feel it. Talk to me.
Schlumberger's. Bacon cheese Schlumberger.
What is happening, everybody? It's your boy Chicago Sean McLaughlin. Joining me today, Steve Straza, a better-looking JC Peretz, filling in for the trade of the week. How you doing, Straza?
That's what they call me. I'm good, man. How are you?
That's what they call you, the better-looking JC?
I get it a lot.
So, we're post-Fed. We've had some wild moves in the market. Just before we went live, you were commenting how stocks are ripping.
Yeah.
I'm trading like an animal over here. You're probably gonna hear orders pinging off as we're talking. So hey.
Usually I'm the one with the sounds.
Usually you are the ones with sounds. Although your sounds are stupid. Mine are the sounds of commerce. Trades actually happening. But anyway, let's get right to it. We talked yesterday. For those of you who saw you and I on the Flow show yesterday, we were talking through some ideas, and we got pretty excited about Schlumberger. We'll come back to Schlumberger in a second because we kind of changed our tune on it. But in our analyst meeting this morning, we were talking about the oil and gas services sector, and I got a chart up here on my screen of the oil and gas ETF ticker XES. What are you seeing here, Straza? What's got your attention?
So we're watching this one as close as anything in the energy space right now because it's the sector leader, right, and has been for a while now. So we're getting new highs, and you can see it right here, right, taking out those pivot highs from last year. But it's not like when we see a breakout, we like to see a decisive breakout. We want to see momentum get oversold. We want to see relative strength coming from that group supporting that breakout, not just new highs, right? So this to me kind of looks like a lazy breakout.
A lazy breakout.
Yeah.
Now,
we're skeptical of these new highs. And we're not getting confirmation from XLE. Explorers and producers don't look good. Not getting confirmation from really any of the other energy subgroups.
All right, so I'm going to bring up the second chart you have of this ticker because this is showing the what is that? It's the RSI, yeah, relative strength at the bottom. That's kind of confirming what you're saying, right? We're not seeing follow through.
We're seeing momentum weaken, at these new incremental highs, right? So this to me looks like a nice setup for a potential failure. It's not so much that we want to bet on a failure. It's either this breakout's going to stick or it's not going to stick. And if it fails, we tend to see sharp moves lower. So we're betting on kind of movement.
Right. So that's the setup. So yesterday, you and I, we were talking about Schlumberger. Here's the chart. From a bullish bet, we were like, hey, this looks pretty good. We like this sector. But now, once we put all our heads together, got the team together, we talked this morning, we talked about what we were seeing broad-based. We were like, hey, maybe this is what we need to be worried about. This chart here, could this be a failure? Could this thing be running out of steam? Yeah. And that led us down the idea of, hey, we haven't done this trade in a while. And JC likes to call them the goodbye or the goodbye trade. And we decided, hey, with volatility so cheap, look at this chart I got here. This is the implied volatility of Schlumberger options going back for the past year. Implied volatility maintained a pretty steady high level for much of the year. And now, as we've gotten to the end of January, look at this volatility just falling off a cliff. It's plumbing the depths, making new lows. What that means for us as options traders is making a bullish or a bearish bet is relatively cheap here. And so we got to thinking, well, why do we have to pick a direction? Why don't we just put a long straddle on and get paid if we have a big move in either direction? Because we can make the case that this thing could rip 20 points higher. We could also easily make a case that this thing is due for a 30-point sell-off, right? Maybe not 30 points, but a significant sell-off.
So that's why we picked the straddle, right? Because sure, it looks like we're breaking out these stocks. And then also just take a step back, right? We talked about XES, the Equipment and Services Index at the top of the call. Schlumberger is the largest stock in that index, right? It's the largest oil services stock. They're not going to move in different directions. We don't want to make that bet. So it's the vehicle that we're using to express it. And then a straddle works. Why are we doing a straddle? Ultimately, because we're thinking we either get an upside resolution or it fails and we get a sharp move lower. That covers us for both, right?
And also, if we get a big move, especially if we get a big downside move, not only will we benefit from the directional bias of the trade, but likely if the stock sells off, we will see implied volatility rise along with it. And that will just naturally boost the value of any options in the position. So that'll give us a little extra juice. So we can win potentially two ways in this trade. And by the way, I just noticed a typo on this graph. I apologize, guys. This is not a strangle. It's a straddle trade. A strangle is when you buy the out of the money call and you buy the out of the money put. This case, we're buying the same strikes. We're buying the 55 put and the 55 call. We're buying them in January. So we have 1 year, basically, a little less than a full year for this to play out. We paid $16 for this spread, which I think it's still, well, I haven't checked. Post FOMC numbers may have changed a lot, but I paid 16 bucks when I put this trade on earlier today. Here's the thing, Straza. While this potentially could be a home run trade, right? If Schlumberger has a big move in either direction, it potentially could be a home run. That is not how I'm playing it though, okay? What I'm doing is I'm actually trying to improve the odds of success on this trade. I'm not going to be greedy with it. I paid 16 for it. I've got a resting order. It's out there right now. Good till cancel. I'm going to sell this spread, the entire spread, if I could sell it for 20 bucks. So all I need is a $4 move. That would be a 25% win off of my invested capital. That's the move I'm playing for. I don't particularly want to hold this spread all the way till January of next year. I would rather be kind of in and out over the next few weeks, few months if I could. Yeah, I'm leaving an order out there to sell at 20. And on the flip side, I'm not just going to let this thing decay all the way to zero. It's unlikely it would decay all the way to zero. The stock would have to pin exactly at $55 per share on January expiration. But if at any time this spread loses as much as 50%, so I paid 16, if it loses value down to below $8 for the spread, I will exit it there. Just be like, all right, cutting my losses. This thing is not working out. Time's working against me. I'm out. That's my plan.
So we're looking for a base hit, not a home run.
Let's call it a double. I don't think a 25% win is a base hit, but yeah.
It's a double. Then, I mean, if the stock rips here and heads back into the 60s, you probably get that 20 pretty quick, no?
I think so. If this thing makes a big move in the next month, we could easily get there pretty quick. But hey, we've got time. Time's on our side. The value of these options will not decay away very rapidly at all because for two very important reasons. Number one, we have almost 12 months until expiration. And number two, volatility already is so cheap in this name that the likelihood of volatility coming in even lower, it could still happen. Of course it could still happen, but it's probably not going to come in that much more from where we're at. So I like our odds in this trade.
I like it too. I think it makes a lot of sense. When we look at this group, there's been a lot of sideways, really been consolidating, these equipment services stocks since April of last year, really just straight sideways. So the next move, I think, is imminent. And it's really nice to get to craft something, use a strategy where we aren't held to what direction that move is in, right?
That's right. All right, folks. Well, that's our trade of the week. A long straddle in Schlumberger, ticker SLB. We bought the January 55 puts and an equal amount of January 55 calls. We paid 16 bucks for the spread. We're either going to get out at 20 for a win, or we're going to cut our losses if it trades down to 8 bucks or less. That's all we got for you, folks. Have a great rest of your trading day. Have a great week. Straza, thanks for pitching in for JC. You always do a better job anyway, so great to have you here.